Okay, good afternoon and welcome to this session of the London Financial Regulation Seminar, which is entitled Analysing the Organisation of the Bank of England, Limits and Perspectives. And I'm delighted to have with us Bill Allen, Professor William Allen, who will discuss one of his last research papers entitled Models of Central Banking and the Organisation of the Bank of England, published by the National Institute of Economic and Social Research, where he also works. In addition to being a visitor at the National Institute for Economic and Social Research, Professor Bill Allen has worked at the Bank of England from 1972 to 2004, and he's been a specialist advisor to the House of Commons Treasury Committee from 2010 to 2017, and also has given evidence to the House of Lords Economic Affairs Committee on quantitative easing and written extensively on monetary matters. Then we will have as a discussant Professor Charles Goodhart, Emeritus Professor at the London School of Economics and former Chief Economist of the Bank of England, as well as member of the first new Monetary Policy Committee of the Bank of England. The paper discusses structural issues, and he will start with some of the challenges that the Bank of England, and just generally central banks around the world, face with their expanding remits and understanding where the governance structure and their status of independence and accountability is adequate. And he will propose, but I will let Bill, of course, I'm not going to continue further into the paper. I will let him explain the paper, why the current structure can be improved, and why he supports the replacement of the current committees by a single board or keeping the PRA committee. So without further ado, I will silence myself and I will give the floor to Bill Allen, who will then have the slides being moved on by our efficient administrator. And when we have, after the discussion by Charles Goodhart, if we have any questions, just put them in the chat, or also at the time of the Q&A, raise your hand using the raise hand feature in the Zoom app. So without further ado, and bearing in mind that this session is recording, the floor is all yours, and thanks, Bill, for being with us again. You also presented the paper a couple of years ago, so you're very welcome back into our seminar. Thank you.
Well, thank you very much for that introduction, Rosa, and thank you very much for inviting me back. As you explained, I want to argue today that the structure of the Bank of England, as it was set up in the Bank of England Act in 1998 and amended after the financial crisis in 2013, is now outdated in the light of developments since then, and that it ought to be redesigned. And the proposal I want to make is about how that might be done. So if we go back 25 years to when the Bank of England was made independent as regards monetary policy, it made perfectly good sense to think of monetary policy as a component of macroeconomic policy that could be managed separately from the others. So the Monetary Policy Committee was set up, equipped with a single policy instrument, namely the level of short-term interest rates, and a single objective, namely the inflation target. The Treasury, for its part, adopted fiscal policy rules to ensure that the public finances remained sustainable. So there was a kind of division of labor between monetary policy and fiscal policy. And at roughly the same time, bank supervision, which was in 1998, was assigned to the new Financial Services Authority. The Bank of England retained responsibility for systemic financial stability. And there was a tripartite committee which was supposed to facilitate cooperation in financial stability between the Treasury, the FSA, and the Bank of England. Meanwhile, public debt management was removed from the Bank of England and assigned to the Debt Management Office set up by the Treasury. It was part of the Treasury. And that was possible because the gilt-edged market had become much more liquid and didn't need any longer the Bank of England to underwrite auctions and act as a market maker of last resort, or at least not routinely. Now, that all worked very well indeed until the financial crisis, when it suddenly didn't. It became clear then that the tripartite committee in particular on financial stability didn't work. The FSA and the Treasury wanted the Bank of England to act promptly as lender of last resort to Northern Rock, and the Bank of England declined. So there was no means of resolving the impasse, and so there was a stalemate followed by a run on Northern Rock. This was a kind of overture to the global financial crisis. Can we move on to the next slide, please? Sorry, I should have mentioned that before. Now, perhaps the next slide after that as well. Events during and since the financial crisis have falsified some of the assumptions that were made in 1997, and economic policy making has changed in several ways. Those include the following. Old connections between monetary policy and financial stability, which hadn't been important, suddenly reappeared. Firstly, the financial condition of the commercial banks became important for macroeconomic developments during the financial crisis. The fact that the banks were in suddenly severe distress was very important for the economic outlook and required monetary policy action. And the banks were supported by official equity injections from the government during the financial crisis, also by loan guarantees and by liquidity support of various sorts. The condition of the banks is suddenly an issue again now after Silicon Valley and Credit Suisse, though happily not particularly in the UK. The second connection, which has reappeared, is that the liquidity of the gilt edge market has evaporated on two occasions in the last 3 years. The first occasions for many years, in 2020 and last autumn in 2022. That is a threat not only to financial stability, but also to monetary policy, because it threatens the government's ability to finance itself without creating money and raises the spectre of fiscal dominance of monetary policy. Now, the second way in which macroeconomic policy making has changed is that after the financial crisis, new instruments were introduced of macroprudential policy managed by the Financial Policy Committee of the Bank of England, which was set up in 2013. Now, those macroprudential policy instruments plainly potentially have an impact on the objectives of monetary policy, so they need to be taken into account by the Monetary Policy Committee. The third thing that's changed is quantitative easing. Now, that was introduced in 2009 in an emergency. It's not a natural monetary policy instrument because, unlike short-term interest rates, it's not a high-frequency instrument. You can't turn it on and turn it off. Once you start a quantitative easing program, it takes several months to complete it, and probably even longer to reverse it. But it can be seen, if you like, as a kind of Tobin-esque policy instrument because it works by changing the average maturity of government debt. And in particular, in this country, over the 12 or 13 years during which it was in operation, it radically shortened the maturity of the government debt by taking out of the market very large amounts of fixed interest government bonds and replacing them with reserve balances in the Bank of England, bearing interest at a variable rate. So it means that, among other things, that the objectives of debt management, or the earlier objectives of debt management, which were to do with minimizing costs and not running serious risks. Those objectives have been subordinated since 2009 to monetary policy objectives. Whatever its other macroeconomic effects, quantitative easing radically changed the government's exposure to interest rate risk. So in 1997, the government had hardly any short-term debt at all. Now it's short-term interest-bearing debt, including, as it should, the reserve balances of the commercial banks, for which the government accepts responsibility. Those amount to about 1/3 of a year's GDP. That's a huge change. The fourth change in the macroeconomic environment, though it's not one that has been all that widely noticed, is that it became clear, at least to people outside the Bank of England, that the Monetary Policy Committee was not allowed to decide on its own what financial operations the Bank of England could conduct in pursuit of its monetary policy objectives. The court of the bank, or the executive managers of the bank, insisted on reserving that function to themselves, and they drew up so-called Concord Acts with both the MPC and the FPC, which in effect compel the MPC and the FPC to choose from a menu of possible market operations selected for them by the executive. Now, as I said, I want to make the case that the organization of the Bank of England is now outdated and it needs to be recast, and specifically that it would be better to have a single executive board responsible both for monetary policy and financial stability, including market operations, and for managing financial risk, including risks for which the bank is indemnified by the Treasury. And in order to do so, I want to suggest that a differently organized Bank of England might have made different decisions in the past 14 years. And there are 4 instances that I want to talk about. The first one, which is on the present slide, is support for bank liquidity after the financial crisis. Now, after the financial crisis, there was bound to be, and there was, an avalanche of new bank regulation, which included liquidity regulation. There was a minimum liquidity coverage ratio, which was first announced in 2009, and which the banks needed to begin to adjust to as soon as they found out about it. It requires commercial banks to hold enough high-quality liquid assets to enable them to survive for a hypothetical month in which funds are flowing out of the bank, for example, through deposit withdrawals, at the maximum rate which is thought to be plausible. The high-quality liquid assets that they have to hold consist mainly of reserve balances in central banks and government securities. There are some other assets, but they're not really so important. Now, British banks, at any rate, had a lot of work to do to reach the minimum ratio. They were well below it in 2009 when they were told about it, and they'd achieved it by the end of 2015. But while during the years when between 2009 and 2015, it constrained their lending, and they were busy trying to attract deposits and other liabilities so as to build up liquid assets. Now, quantitative easing, as it was implemented during that period, did absolutely nothing to relieve that pressure on bank liquidity, because quantitative easing simply exchanged one high-quality liquid asset for another. It didn't increase the total supply. So that was kind of irrelevant to that particular issue. But there were other schemes that did help. For example, the special liquidity scheme. But those were smaller and reversed much more quickly. Now, the MPC wasn't consulted about the special liquidity scheme, either when it was introduced in 2008 or when it was terminated in 2012. I think it should have been. And I speculate that if it had been, the scheme would have continued for longer, because it's quite clear if you look at the data that bank credit slowed down a lot in 2012 and 2013 when the scheme was terminated. That's my first instance. Could I have the next slide, please? The next slide is about what I call the good friend doctrine, after the late Marvin Goodfriend, who was perhaps its leading protagonist. The securities that the Bank of England bought were nearly all, though not quite all, government securities. And the good friend doctrine, which was, as far as I know, first put about in 2009, was that central banks should hold no assets other than government securities, except for limited amounts in exceptional circumstances. This is a matter of principle. The idea is that otherwise the central bank is committing an act of fiscal policy for which it lacks legitimacy, and in any case that it isn't equipped and it doesn't have the right to express preferences among private borrowers. Now, I don't want to discuss the merits of the good friend doctrine. A lot of people subscribe to it, but the point I want to make is that it isn't something on which the MPC was consulted. That was decided for them by the Bank of England executive, as provided for in the Concordat. And again, it seems to me questionable that the MPC was not allowed to determine its own attitude to the good friend doctrine and the choice of the Bank of England's assets. Could we have the next slide, please? The third issue that I want to raise is about gilt maturities and financial risk. Now, the QE means buying lots of bonds with borrowed money, and it's financially risky. The financial profit or loss depends on the difference between the yields on the gilts that have been bought and the cost of borrowing at a floating rate of interest. It was agreed right from the outset that the risk would be borne by the Treasury because it indemnified the Bank of England against losses and equally got the benefit of profits. Now, in practice, the MPC doesn't seem to have discussed very much the maturities of the gilts that will be bought. In practice, they've avoided very short maturities, less than 3 years, on the grounds that short gilts were likely to be held by banks and overseas central banks. That suggests a concern with money supply. But the maturities that have been bought have extended far beyond 3 years, out to about 30 years. Now, buying long maturity bonds is risky, and it implies a view about short-term interest rates in the distant future, long beyond the time horizon of the MPC. And the MPC is no better placed than anyone else to have such a view. Now, the financial risk that the QE program involved would be much less if the maturities were confined to a period during which the MPC expected to keep short-term interest rates low. It could be argued that the MPC should buy only bonds maturing within its own time horizon. As it is, the QE program has made, according to my calculation, a mark-to-market loss amounting to £67 billion as at October 2022. That's starting from the beginning in 2009. That doesn't include the purchases made after the Truss Kwarteng budget in September 2022. That's a separate operation, which actually ended in a profit. But the remaining holdings of the Asset Purchase Fund, which holds the QE gilts, still very risky, and a 1 basis point change in the yield curve, up or down, affects the value of the portfolio by £500 million, roughly. In other words, there's a lot of risk left in it. Now, of course, the QE program has to be evaluated not only on it according to its financial cost, but also, more importantly, according to, or likely to be more importantly, on its macroeconomic effects. And in principle, it has to be compared with other possible policies that might achieve the same macroeconomic effects. But it does seem likely to turn out to be very expensive. Now, the point I want to make here is that nobody appears to have felt responsible for managing the risks or weighing them against the benefits. The Treasury seems to have approved quite readily all the requests from the MPC for indemnities for further tranches of QE. I should add that the same thing happened in the Federal Reserve and the ECB, both of which did big QE programs and both of which made big losses, or appear to have made big losses. Could we have the next slide, please? Last of these 4 issues, last resort market making. As I mentioned, gilt market liquidity evaporated on 2 occasions. Firstly, in March 2020, when it became clear that the COVID epidemic was going to cause serious economic disruption. And secondly, after the Truss-Kwarteng fiscal event in September 2022. Now, the procedure in 2020 was that there was an emergency meeting of the MPC, which was evidently triggered by the events in the gilt market, and which decided but to respond by another tranche of QE amounting to 200 billion, which was later followed by a further 250 billion. This was to restore market functioning and in the interests of the inflation target. The FPC was pretty much in the background during that episode. But then in September 2022, the symptoms were much the same. The gilt market dried up, particularly at the long end. But then it was the FPC which took action. That had an emergency meeting, noted the market dysfunction, and urged the Bank of England executive to implement a market maker of last resort, which evidently knew that the Bank of England executive were planning. And that was an outstanding success. The Bank of England bought 19 billion of gilts and was able to reverse them promptly and at a profit. Now, in both those cases, the market breakdowns threatened both monetary policy and financial stability, and both market maker of last resort operations serve both monetary policy and financial stability objectives. So who decides which committee should take decisions? It is important that it should be clear, because it can be dangerous to have to make procedural decisions in an emergency, and I don't think it is clear. Could I have the next slide, please? Looking ahead, there are more likely developments that will raise questions about which bit of the Bank of England it needs to be active, and about how the liaison between the Bank of England and the Treasury is going to work. And the first is fiscal policy. As I said, the post-1997 structure was based on the assumption that fiscal policy would be constrained by a rule that it ensured that the public debt remained sustainable. That assumption was essential, because without it, you couldn't exclude the possibility of fiscal dominance of monetary policy. In other words, a situation in which the debt to GDP ratio was rising and the government couldn't sell bonds in sufficient quantities to refund maturing debts and any ongoing deficit. And as we know from Sargent and Wallace, in that situation, there's nothing a central bank can do to contain inflation. Now, as you can see from the left-hand graph, since 1997, the government debt to GDP ratio has roughly trebled to about 100% because of the financial crisis, and more recently because of COVID. And there is a forecast section of the chart on the left. This is from the OBR. Shows a fall in the debt to GDP ratio, but it's a pretty modest one. And it doesn't begin until after the general election. In other words, it's a problem for the next government, not this one. Meanwhile, the prospects for getting the debt to GDP ratio down don't look great, because if you look at the chart on the right, which is also from the OBR, you see that the tax to GDP ratio is about as high as it has been in the entire post-war period. Now, that makes it likely that the gilt market, which is going to have to deal with ongoing deficits, heavy maturities, and unwinding of quantitative easing, all at a time of uncertainty about the stability of public finances. All that makes you think that it's extremely likely that price discovery will periodically be very difficult, and that there'll be more interruptions of market liquidity like those of 2020 and 2022. Could I have that next slide, please? The second issue is bank liquidity regulation. The traumas of Silicon Valley and Credit Suisse show that the liquidity coverage requirement is out of date. That's the liquidity ratio that I talked about before. The liquidity coverage ratio, as I said, is about holding enough liquid assets to keep you going for a month when you lose as much cash as is considered plausible. But actually, certainly Silicon Valley and probably Credit Suisse lost deposits much more quickly than the calibration of the requirement assumed. And Andrew Bailey has pointed out that the UK subsidiary of Silicon Valley lost 30% of its deposits in a single day. So it's obvious that liquidity regulation will have to be reconsidered. There's an obvious temptation to use the ratio as a means of increasing demand for government debt. There are certain objections to that. One is that the minimum liquidity ratio in effect freezes liquid assets. Another is that it pressurizes the central bank to monetize government debt in an emergency. And the third one is that it ignores the inherent liquidity of some short-term loans to private borrowers. But any revision, this is the main point, will affect the objective of monetary policy. So, for example, a simple tightening of the liquidity coverage ratio would cause credit to be restricted and would affect the inflation outlook. It would need to be decided on by experts, not only in banking, but also in financial stability and monetary policy. Next slide, please. So, to summarize, the issues that the Bank of England has had to deal with and will have to deal with can't be classified simply as monetary policy or financial stability, and nor do they affect the Bank of England alone. As I said, the debt management objectives of the DMO have been subordinated to monetary policy, so that the Treasury and the DMO have been affected incidentally but heavily by the MPC, which doesn't appear to have internalized the financial costs and risks of its action. Liquidity breakdowns in the gilt market are likely to continue. And the Bank of England can no longer ignore fiscal policy or assume that it'll be taken care of. So the division of labour, which was assumed to work in 1997, is no longer reliable. Bank liquidity regulation has to be reconsidered. And all those things, none of those things fits into a box labeled monetary policy or financial stability. And some of them don't even fit into a box labeled Bank of England because they involve the Treasury too. Do you think I could have the next slide, please? So now I come to the proposal. The structure of the Bank of England now seems Byzantine. The interrelationships between the decision-making bodies have to be carefully managed. They have concordats. There's an evident lack of clarity about demarcation. It would be simpler and I believe much more efficient to have a single executive board responsible for monetary policy, financial stability, and financial market operations, as well as for internal management of the Bank of England. In my proposal, it would, as the MPC and the FPC do now, include members from outside the existing Bank of England staff. It would be responsible for the financial risks taken by the Bank of England, including those taken under the indemnity of the Treasury. It would need to be able to meet at short notice, and the minutes would be published, except as regards internal management. The PRA board, I think, for practical reasons, would continue as at present, but plainly the executive board would need to be briefed by the PRA board when it needed to be. And there would need to be arrangements for liaison with the Treasury, both about fiscal policy and about market operations involving both government securities and foreign exchange. And clearly, I believe that a Treasury representative should attend the board meetings, other than for internal management purposes, and that the DMO should brief the executive board. Next slide, please. How would this help? Well, the first point to make is that one way in which it couldn't help is that it couldn't permit trade-offs among objectives, price stability or financial stability, because they're not permissible under the statute, nor would they be desirable. But a single executive board would make it much easier to discuss trade-offs in the speed of meeting objectives. For example, if you have to tighten up bank liquidity requirements, what's the trade-off between the speed of tightening those up and the speed of meeting the inflation target? It would it could more easily discuss how objectives would be met. For example, what assets to buy in quantitative easing programs. It could discuss financial risks either to the Bank of England or the government. And in a board like this, all members would internalize the trade-offs rather than making a decision which a different committee has to fit in with. Next slide, please. I don't believe that the proposal will weaken the independence of the Bank of England. In principle, the Bank of England's already been weakened. The independence has already been weakened by QE because that requires the Treasurer's assent. In practice, or so it appears, the Treasurer's assent has been freely given since 2009. And in practice, the Bank of England, so therefore, has been kind of super independent because it has had the objectives of debt management subordinated in its own interests. But it wouldn't be sustainable for that to continue permanently. And the Bank of England can't remain super independent. So the proposal, I think, merely recognises facts that the objectives of the Bank of England are interdependent, and that actions taken in pursuit of one affect the other, and those of the Treasury. That the threat of fiscal dominance can undermine the objective of price stability, and the debt management policy can affect the bank's monetary policy objectives. And it seems to me that the bigger risk to the independence of the Bank of England is ignoring those facts. Perhaps I'll stop there because I've used up my time and I think I've made the main points. Thank you very much.
Thank you very much, Bill. And without further ado, I'll give the floor to Charles Goodhart, which I said at the beginning is Emeritus Professor of the London School of Economics, also my maestro and someone with whom I have worked for very many years. And with regard to what Bill Allen just presented, he was actually part of the first MPC that the Bank of England set up following the granting of operational independence in 1998, and someone whose wisdom in central banking matters has been sought by many in this forum and elsewhere. So, Charles, the floor is yours. So you have around 10 minutes, and then I will open the discussion for Q&A. Thank you for being with us.
Well, thank you, Rosa, and thank you, Bill. I admire and agree with virtually all your historical analysis about what has happened, what is currently happening. Where I disagree with you, Bill, is whether your structural changes that you suggest to the Bank of England and its committees would actually do any good. I don't think they would, and I don't think they're actually possible. What I think that you do not really fully understand is the very different functions that the MPC has and the FPC. And also, I think your suggestion that a single committee could handle financial crises is actually invalid. When you get into a financial crisis, things are happening extremely fast, and decisions have to be made very quickly. And the normal way that this is done when you've got a real crisis is that the decisions are actually achieved by an agreement between effectively the top brass, a very few people in the central bank, the top brass in the Treasury, and usually the top politicians. For example, with SVB, in order to deal with it, they had to describe the event as systemic. In order to describe an event as systemic, under the law, there had to be agreement between the Fed, the Treasury with Yellen, and indeed the president himself. And exactly the same has to be done if you've got the kind of problems that we had with ODI and that we had in the course of the financial crisis, great financial crisis. Crises of this kind get settled between very few absolute top players on the basis of their information and beliefs about what is happening. The idea that a sort of committee of about sort of 10 people could discuss this with the Chancellor of the Exchequer and the Prime Minister, I think is actually ludicrous. So the crisis decisions will always be undertaken and have to be undertaken in the kind of way that they have been, and indeed were very recently so. The other issues about merging the MPC and the FPC, they're very different animals. The MPC has a clear target. It has one basic instrument. We can talk about QE in a moment, the nominal interest rate. It has to take a decision that is very clear once, or I think it's about 10 times a year now. That decision comes into immediate effect, but it can be reversed or changed at the next meeting, which is coming along fairly soon. So it's not actually urgent at any time to take that decision. With the FPC, the objective is much more diffuse. You talk about financial stability, but trying to measure financial stability is extraordinarily difficult. There are loads of instruments that you can use, and they have differing time schedules. Many of these, such as changing the LCR, capital requirements and deposit insurance, involve considerable structural change and have to be introduced gradually rather than with immediate effect. In many ways, The MPC is a decision committee. The FPC is much more of a think tank, discussing what actually might be done, where the dangers are, how the dangers might possibly be resolved, and therefore actually has a rather different cast of characters. The FPC, for example, has had people coming over from the US and coming over fairly regularly, people like Don Cohn and Anil Kashyap. So I think their functions, characteristics, and natures are quite different. And trying to put them together, I think, would wildly overload the MPC, and assuming that would have to remain as a sort of the key committee, for no useful or good purpose. The reasons, I think, for the division are fairly clear. It's a division of function, it's a division of nature, and that was going to go on. Let me just move on to QE. There was a slight suggestion that QE might not have been maintained or continued as long as it was if it had been put to the MPC. I don't see any case for that being true. The forecasts of the Bank of England, as I'm sure you know, Bill, were and remain actually that inflation is going to always go back to target in 2 years' time. And that until we got to 2021, the concern was always, both here and in the United States, that interest rates by themselves, because of the effective lower bound, were not going to be sufficient to raise inflation back to target. So QE was actually encouraged, approved of strongly by the FOMC and effectively by the MPC in the UK. The idea that if the MPC had been given the ability to decide on this, you'd have had anything different, I think is simply not the case. So, and I agree with you that not everything has been perfect, but I think the suggestion that the kind of changes to the structure of the Bank of England's committee system would make a significant difference or any improvement is actually wrong. I think that the division between the two committees is fairly clear and generally beneficial. So I don't think that the committee structure has really made any significant difference to the kind of policies that we've had. And I don't think that changing it in the way that you suggest would actually improve anything. So let me leave it at that.
I was on mute. Thank you very much, Charles, for that commentary, critical commentary. And I will leave Bill sometimes to think about how he responds to you by opening the floor to some Q&A. So who wants to ask the first question? Either put it in the chat or raise your hand. Okay. Hasrat Mehta. Yes, you can ask the question. And then Eva Luis and then Pedro. Okay. I cannot hear you.
Thank you.
Yes.
Thank you. I hope I'm audible now.
Yes, that's fine. Thank you.
So I'll just pose a question. Any of the luminaries on the panel would be, whoever wants to take it up, please. I hope it's to your level. So the only thing I haven't been able to read your paper fully yet, but my question is, will the traditional model of central banking independence, is that impacted, and in what ways, by the changing financial markets and monetary policy dynamics, especially if we're talking about, let's say, the unconventional tool of quantitative easing? How does that impact the traditional role and the structure or the organization of a central bank and its independence?
Okay, first Bill and then Charles.
Thank you.
Well, I think that as I said, one of the impacts of quantitative easing has been to greatly increase the sensitivity of the government budget to the level of short-term interest rates, which of course is managed by the central bank. And there is bound to be a concern that the government will want to put pressure at times on the central bank not to raise interest rates so as to save itself from higher interest costs. So yes, there are at least grounds for worry that the central bank's independence might be threatened. The other point is that because debt to GDP ratios are much higher than they were 25 years ago, that we're closer to a situation of fiscal dominance, in which, as Sergeant from Wallace explained a long time ago, there really isn't anything at all that the central bank can do to contain inflationary pressures. So yes, I think that there are reasons to be concerned about the outlook for central bank independence. They're nothing to do with the people involved. It's simply that the numbers have changed, and that affects the behavior of the institutions involved.
Charles, would you like to add anything?
The structure of the financial system does affect the role of the central bank. Let me take an example. The combination of the regulation and the availability of marketing through high-speed, high-frequency trading meant that when something unexpected hits the gilt-edged market, that liquidity evaporates, because the main commercial banks, because of the regulations, are not prepared to as market makers as much. The high-frequency traders disappear when something critical happens. So that is likely to be another reason why the central bank will have to enter into managing and supporting liquidity crises in gilt-edged markets to a much greater extent than in the past. Another example is that the development of money market funds in the US enabled the withdrawal of deposits from many of the middle-sized banks in the US to leave the banking system altogether, because they went to the money market mutual funds who then put the money with the Federal Reserve. And that actually made the crisis considerably worse. So yes, the changing dynamics of the financial system do have a significant effect on what the central bank has to do. And that dynamic development is likely to be ongoing, let alone possibility of CBDC and all of that in the future.
Yeah, let me just second that before I go to the next question, that certainly the dynamic of the way that both monetary policy and macroprudential supervision, as well as other functions that the central bank has or decided, is very much affected by the increasing interrelation between the complexity of a number of objectives: price stability, financial stability, debt sustainability. Now, if we go into digitalization and also potentially climate change. So there is always the argument that is being made by some that perhaps we're asking too much of the central banks to do. And that certainly is changing the dynamics. And as Charles was saying before, one of the concerns about the domain of financial stability is that it's not so easily defined. It's much more easy to define price stability than it is to define financial stability, which sometimes we can only define ex post, once that we have seen the dynamic of a crisis unfolding. But we have a question by Ivan. Ivan?
Thank you.
Yes, can you hear me?
Yes.
Yeah.
I would like to ask William and Professor Charles about to expand a little bit the tensions between monetary objectives and financial stability objectives regarding the last minor crisis that we have in September 2000 with SVB and the minor crisis September 2002. And I would ask you a little bit about accountability, but I would expand a little bit the subject. Since we saw William's presentation and some proposals to in his paper, I would like to hear a little bit longer for Professor Charles about the accountability and mandate about central bank's mandate, especially regarding quantitative easing. Right now in the UK, the central bank balance sheet is almost 30% of its GDP, if I'm not wrong, to 850 billion pounds in assets. So Professor William told us about the super independence and gave us a proposal to balance it with central bank mandate. I would like to hear from Professor Charles about his views on this, and it would be better for central bank to keep it like it's right now.
There was a paper recently by Ellen Ray, and a colleague whose name I've forgotten, which actually worked out that up till 2019, indeed up to 2020, the central banks were making enormous profits by undertaking QE, and effectively was indicating that as long as interest rates were very, very low and expected to remain low, this was a highly desirable activity. The problem was not that they didn't observe the risk, they didn't think it was coming. Central bank forecasting has more or less continuously assumed that inflation was defeated and that we would return to lower for longer very quickly. Again, what I would suggest that you do is you read Ben Bernanke's book on monetary policy in the 21st century, where he argues for more and more quantitative easing and yet further measures to try and expand monetary policy. It was not a failure of the structure of committees. It was a failure of central bank forecasting to foresee that there was quite a high probability that interest rates and inflation would rise quite sharply, and in my view, are quite likely to remain higher. So it wasn't a structural problem, it was a forecasting problem, and it was partly a forecasting problem, I think in large part because the models that central banks used were not very good. So if you want to throw a sort of concern at anyone, I would throw concern at the macroeconomic models that central banks have used. It was the economists who were at fault, and it was not a problem of that the central banks weren't accountable. They were just wrong.
Thank you very much, Charles, for that critical view. Bill, would you like to respond both to Charles and to the question by Ivan?
Okay. Well, if I could start off by responding to Charles. I mean, as regards crisis management, yes, of course, I accept what he says, that in practice, whatever the committee structure is, the governor has to be delegated to conduct negotiations with the government central banks and whoever else is involved. And I think that that applies to any structure. I don't think there's any question about that, and I wouldn't dispute it. As to my specific proposal, well, I mean, I put forward the arguments for it, and one can agree with them or not. The only thing I would question is the suggestion that it's actually impossible to do what I suggested. I think I've got pretty solid evidence because quite a number of other countries have done it. Sweden, for example, but not only Sweden, quite a number of others. And if you think about it, the Federal Open Market Committee conducts many of the functions that I'm proposing the executive board of the Bank of England should conduct. So whatever else you say about it, I don't think you can say it's impossible. As to the last question about the relation about monetary and financial stability objectives in September 2022, clearly there was a financial stability objective, what had been a monetary policy instrument was used to address it. And it so happened that addressing the financial stability objective meant actually reversing monetary policy for a short period and then unreversing it. It seems to me that it's pretty difficult to say that it was a monetary policy operation or a financial stability operation. It was both. As regards SVB, well, that hasn't really, as far as we know, had any major implications of any kind for the UK. I mean, the UK subsidiary of SVB was fairly small, and the Bank of England were able to find a buyer over the weekend, and that appears to be a fairly seamless operation, which has gone very well, as indeed the September 22 operation did. But I do question whether in the future, as I said, it's going to be possible to distinguish clearly between monetary policy problems and financial stability problems. And that's what lies behind my proposal, which from which I'm unmoved.
Okay.
Thank you very much.
Thank you very much, Bill. And the last question by Pedro. Pedro?
Can you hear me?
Yeah, we can hear you, yeah.
So really quickly, thank you very much for your presentation on a two-part question. I believe the first part has at least partially been answered, but please correct me if I'm wrong. So I would like to know your comments, Professor Allen, on whether you think that all of the expansion of the regional really mandates has compromised the independence and the credibility, especially in the fight against inflation. And the second part is you comment that the liquidity coverage ratio is outdated, or at least not adequate anymore given the current scenario. So whether you have seen or studied any suitable solutions or any ideas.
I'm not sure I heard the questions, but I'll answer the questions I thought I heard.
So he asked you if you think that the expansion of the mandate of the Bank of England compromises the independence and credibility in the fight against inflation and risks politicization.
Yes, I think it does. And in fact, I think it has done. I think that the Bank of England's inflation mandate commits it, first of all, to achieve price stability, and subject to that, to promote the economic objectives of the government. And I think that they have overemphasized the secondary objective and not being sufficiently concerned about the primary objective. So it has happened. As regards the liquidity coverage ratio, yes, it's self-evidently inadequate because the the figures that are included in the rules put out by the Basel Committee on Banking Supervision were not anything like adequate to deal with an outflow on the scale that the Silicon Valley UK subsidiary experienced. As to what to do about it, I think it's very, very difficult. And I certainly can't provide an answer in the period between now and the end of the seminar. I mean, there have been attempts to produce sensible liquidity rules which don't, in effect, freeze the liquid asset requirement and make it illiquid. But it's very doubtful, I think, whether they would have been effective in these cases, or at least it's not certain. And as I said, there's also the point that the liquidity coverage ratio, as specified, deliberately or less likely accidentally, acts as a kind of covert requirement to invest a minimum proportion of assets in government securities. And it's very difficult to see governments wanting to give that up in current circumstances. So I don't have a satisfactory answer for the question, but I can acknowledge that it's an important and difficult one.
Thank you very much. And Charles, just very briefly, and with that we will finish.
I would deal with it by increasing deposit insurance quite dramatically. And then the question comes about moral hazard. And Rosa and I have written about that. So if you want to follow that up, just Google Goodhart and Lastra. I think it's called Speaking Truth to Power or some such phrase.
Anyway, with that comment and that reference, I just want to thank again Bill Allen very much for his interesting paper, which is very much in line with some of the issues that have been posed in the current inquiry that the House of Lords Economic Affairs Committee has launched, looking into the operational independence of the Bank of England, looking at the remit, looking at the governance structure, including the structure of the committees. So the paper is very timely. We got today a good discussion, a critical assessment, as it befits a subject which, obviously has different sides. And I thank you very much, Bill Allen and Charles Goodhart, for the time and the very provocative discussion that we have had this afternoon. So wishing you all a good evening. Thank you very much. And the session will be recorded, and I will make the recording available to the participants as well as to the speaker and discussant. Thank you very much.